Hello everyone, welcome to another session on dollar INR and Indian currency markets. This time let me start with crude because a lot of dollar INR volatility is completely dependent upon crude. So this is the Brent crude oil chart, a 4-hourly chart. Okay, we have been following this chart for quite a while. I want to highlight two particular things. First is this gap region, which is acting as a big fulcrum to this entire chart. Okay, so if you see the prices have gone higher, come down, but it is more or less trading around this gap region of 93.95, 93 to 95 or 94 to 96, that region. So that is the place where it is finding support. Okay, now another interesting thing is, last few days, again, the war worries is not coming down. Strait of Hormuz is again a chicken's neck, and it is a very uncomfortable situation. So we saw crude prices consistently going higher in the last few days, from around 95, 96 to almost like 105, 106, a $10 jump. Then today morning, again some rumors about some peace talk and all, and we saw a big $5-6 decline in the Brent crude oil. And currently it is holding around 100 plus minus $1 on Brent crude. Okay, so crude is still hot, still boiling, not cooling off, and completely dependent upon geopolitical situation in the Middle East. Okay, so let's now try and see what is the impact on dollar INR on this. Okay, now we have been following this uptrend for a long time, very clear-cut uptrend, and since we saw crude prices going higher, that has pressurized the rupee, and dollar INR has gone higher again. It was, relatively very stable for a few days, probably a couple of weeks, around 92.50 to 93.50. What I spoke last week about some tranquility in the market. But then in the last 4 or 5 days, we have seen once the crude has gone from 95 to 105, dollar INR has gone up from 93 to 94, and currently today it traded mostly around 94. Yesterday also it traded around 94. Okay, so rupee is still weak and dollar is strong, primarily because crude prices are not cooling off. Okay, so in such a situation, it is very challenging to manage risk for both exporters as well as importers. Okay, a bigger risk for importers because the currency is going against them, and a much smaller risk for exporters, but since they have to hedge, a bigger challenge for them as well. Okay, so let me show you something else. Okay, let me show you how the vanilla option premiums have changed. I had talked about this in my last video, and I want to re-emphasize this because this is the golden opportunity for all exporters and importers to use this to hedge. Okay, dollar importers can take a simple plain forward and hedge themselves. Premiums are lower, rupee weakening risk is higher. Okay, but at 94, do you want to do a forward? That is a very big challenge for dollar importers as well. Okay, so vanilla option is the key, is the solution for both dollar exporters as well as dollar importers. Okay, obviously dollar exporters can't do a forward because rupee tends to weaken more than the premium. And dollar importers can't do a forward because the spot itself is very high. Okay, so differing challenges, different situations for exporters and importers. What is the solution? The solution is a vanilla option. Vanilla option will give you the protection, but it will also give you the flexibility if the market moves in your favor. It will protect you if the market goes against, okay, and it will help you if the market goes in favor, and all at the cost of a certain option premium. So option premium is the most critical element for a vanilla option. And here I want to show how option premiums have actually come down in the last 3 to 4 weeks. Okay, so what have I drawn here? I have drawn a very simple table. Okay, and this is starting from 30th of March. Okay, if you look at the most extreme table, this is 30th of March. 30th of March, if I took a 1 month option where my option strike price is equal to the forward rate, the option premium was 97 paise. very, very high. Okay, if I took a 2-month option, the option premium was 1 rupee 19 paise, extremely high. So you see, I have plotted here. This is, the blue is the 1 month, red is 2 month, green is 3 month, and yellow is 4 month. Okay, the option premiums were very high till 30th, till 7th of April. If you see how it has stabilized or come down after 7th of April. So if you look at 10th of April, 15th of April, in the last 1 week or so, how all the option premiums have come down. Okay, all the option premiums have come down. And what is really interesting is, if you see last 2 days, the premiums have not come down anymore. It has come down and it has stabilized. If you look at all the option premiums, if you look at these 2 days, 22nd, that is day before yesterday, and today, all the option premiums are very close to each other. Okay, so it is all close to each other. It has gone horizontal. It was coming down and then it has gone horizontal. So that indicates that it is some kind of a base formation in the option premiums. So what does that mean? That means it is unlikely that this option premiums for the last 2-3 days, it's going to go down any further from here. Okay, what does that mean? That means that vanilla options are already very cheap, and that is extremely good news for dollar exporters and importers. Okay, an option, a 1 month option which was costing 97 paisa just about 3 weeks back, it is just costing 58-59 paisa today. A 2 month option was costing 1 rupee 19 paisa 3 weeks back. It is just costing around 80-82 paisa today. Okay, so option premiums have come down, spot has gone higher, the uncertainty in the Middle East continues, crude prices are still very high, above $100 a barrel. The bottom line, risk management for all exporters, dollar exporters and dollar importers is, please do vanilla options to manage your risk. Okay, exporters might feel that spot is very high, I can do a forward. You can do a forward, but along with the forward, also do some vanilla options so that you get flexibility if rupee weakens. Similarly, for dollar importers, if you are looking that this is just too much, I have to hedge and eliminate risk by using a forward, you can still do a forward, but also do vanilla options. Okay, because if the war cools off and the crude prices come down, then rupee might recover, and vanilla options will help you in that phase of rupee recovery. Okay, so strong recommendation to all dollar exporters and importers. Since option premiums have come down, this is probably the best time to do vanilla options since the cost is too low. Okay, so please explore options and make it an integral part of your risk management strategy. Okay, so that is it from my side. Have a great evening and a happy weekend ahead.